Alright, welcome yet to another video. Today I'd like to share my view on trading options as a body investor and why I don't encourage it. So first of all, I feel like it spurs you on the wrong start, right? Using a small capital gain to earn big bucks is the nature of options. There's a huge amount of leverage involved, but you're an investor, right? You have a long journey to ahead of you. So what mindset are you cultivating in this? And what with that mindset you produce that kind of results that you want. Do you prefer a flash in the pan success, or do you prefer slow and steady methodical gains? And also when you were to have a good win from options, you to me that's gambling, and with gambling it's spurs more gambling, and that's the nature of greed, right? Will you be able to control yourself? And should you find quick success, is your brain mentally mature enough to cope with the sudden influx of wealth? Are you able to steward it wisely, or will you squander it away like a prodigal son? Right. Next is about the options grid. So these are delta, gamma, theta, vega, and rho. They all have influence to the premium prices, right? So to me, I want to keep things simple, and first principles does so. It's already hard enough to make money, but so why do you want to make yourself your life more complicated, right? So I mean, it will take a lot of effort to understand how each Greek have its influence on the premium price. Yeah, it takes a lot more studies. I would rather that this time is better off used somewhere else. Next, options can be even more complicated, right? There are these strategies called multi-legged options that you can employ to reduce risk and still get exposure. And again, it defies first principles, right? You want to make money in the simplest possible method, which is to me that to guess the right direction. So why do you need to involve yourself in multi-legged options and different strikes and all that? So is it about looking smart, or is it about being profitable? What is the angle that you have in mind? Okay, I mean, to further add on to the complication that it has, let's just compare. To make money, you need to be in a position of the correct direction of the move, right? It's so you either buy or sell, put a stop loss and a take profit level. But with trading options, you need the following parameters, right? Your desired premium. You might not be happy with 50-cent premium. You want a $2 premium. So you go for a riskier strike. And then you have to choose your expiry as well. You need to choose your direction, which is, and then you need to choose whether you are buying or a call or put. Then further on, extend your strategy whether you want it a single leg or multi leg. And then lastly, put your stop loss and take profit. I mean, the black ink are the commonality between those 2 points. But with options, you need another additional five more parameters to consider. When you need to decide in a split second whether to enter or not, and all these things are already hindering your decision. You may have already missed the move that you might want, the price that you intend to enter. Yeah, so don't complicate yourself, right? And earnings call is one of the ways that people, make a lot of money, and they like to post it on social media, but they do not post their losses, right? But I just want to say that in earnings call, it goes either direction, right? You do not know with certainty you where you go, right? Even if you make monies, can you do it consistently over every earning call? Yeah. And another strategy that I see going around is that they track the large orders, or rather large volumes in the options flow. Like if they see somebody positioning themselves on a particular side of a instrument or stock, then the the public receiving this information may think that, okay, could there be insider knowledge about this particular instrument or stock, right? So should I be on board with this person? So there's a lot of unknowns here, but from what we can see is there's certainly a large position size, and you never know when they plan to close the position, right? And it's not exactly updated live. You have to pay for the data to get the live information, I believe. So with this large position, of course, there are big pockets out there. You never really know what their strategy is. They could be hedging, they could be inducing you to trade, or some other strategies that you may not know. So with all these unknowns in place, why do you want to engage in risk if the odds doesn't tilt in your favor, right? And another idea floating around is that you could sell puts as a mean of passive monthly income. But I'd like you to rethink about this again, truly to do some study and homework on this. Have you considered the premiums that you receive versus the limited upside exposure that you may have, and compare the risk that you took? Okay, so I in this table I list out an example of selling option as compared to buying a stock, right? So let's say a stock is priced at $100. I don't believe you'll come back to $100. I'm very bullish for it, right? So I sold at the same strike at the money for $1. It's just an arbitrary number, okay? And on the other side, if I would like to buy the stock, I just buy $100 with a stop loss at $99. Okay. So for selling put, I receive a premium of $100. Then when it comes to the time of expiry, let's say the stock is at $102. My total balance is 101. Sorry, $10,100. Okay. But for the other position that I chose to buy one lot instead, I would have sold the stock at $10,200, and I profited another $100 more. So this one is meant by the limited upside. Okay, and let's say the stock did not go went against you, so you drop to $95 at the time of actual expiry. You are then obligated to buy one lot of stock at $100, right? So you fork out that $10,000 to buy one lot of stock, and you have $100 premium that you have received. So your total balance now is 95,100. Oh, sorry. This should be a 9,600 instead. Okay, so there's an error here. Forgive me about that. And then, but here, your total balance would have been 9,900 because you have stop loss at $99. Okay, so this goes to show that w- I don't really see a sense in selling options, and that they can some of the educators or vendors out there is telling you that, oh, with this premium that you receive, whatever the amount is, it can be a means of passive money income. But if you could, study and the movement of price, you could have also gain out on more if it's a bullish market, right? And I mean, in general, markets tend to be bullish over the course of the years. So just food for thought, right? Take this back and think whether this makes sense for you. Okay. So I believe selling puts is just one possibly for one more advanced strategies. But if you are just a budding investor, right? Why do you want to make yourself more complicated? Okay. So here is my last slide. Some suggestions for you. If you are still keen on options, go ahead. Right? Like all things, do your homework. study, put your heart to it, understand risk, what's the maximum pain that you can get, and mentally rehearse if it's within your tolerance level. I know sometimes you can just feel a certain sum, you have lost a certain sum, but then you might not physically feel it. So really, really ask yourself, are you willing to lose that amount of money, right? And avoid selling naked options. That means non-cash secured puts and uncovered call. Okay, because you are really treading on thin wall. Because you are meddling with margin and that gets you bankrupt, right? Don't be tempted by high premiums without knowing what's the amount you can lose. So back to the point one, don't look at this carrot and without knowing what's behind the carrot, right? Okay. And single leg, I believe, is sufficient to make money as long as you can guess the direction of the move. That means you can either buy a call or buy a put. And I think that's should be the safest because buying, well, you can only lose the amount that you fork out to buy that particular options contract, right? Unlike selling, you have unlimited risk. You are obligated to fulfill to buy the stock at the strike price when options expire if it's in the money, right? And I would think that you need to show profitability over a minimum period of 6 months. Okay, like actually you would take more, but prob minimally really 6 months, because in a whole year we have different seasons, right? So it's good to understand the seasons of in a year to get the flavor and experience. But nobody will follow these expiries anyway, right? Just wait until you have the skin in the game. You know what it takes to be a successful investor or trader. Then you will understand why it would take minimally 6 months, right? And this is probably on the fast track already. Okay, and I would personally avoid options on individual stocks as they can be manipulated by news. Whether it's a rumor or whether a good rumor or bad rumor, the price will suddenly shoot up or tank down, and that affects your position already, right? So I prefer indices because they are more predictable. All the news have been planned, whether it's the economic release, the manufacturing data, the jobs data, everything is already pre-planned like a TV program. And you can avoid those days if you know that a certain news is more deemed to be more impactful, so you can avoid to trade on that. But unlike stocks, a rumor can happen anytime, right? So that's the risk, another risk that I will avoid individual stocks. And lastly, don't learn options, right? Learn simple buying and selling instead. Okay, learn about price action and why price gravitates towards this and why does it reverse and all that. If you'd like to learn more, continue tuning in my channel as I provide uh, videos which I think will be valuable. And thank you for watching.